Financial Planner, presented by BSC, Investors Protection Fund.
Hello and welcome. You're watching Financial Planner, and today we'll talk about one common subject that we talk about all the time, and that's equity mutual funds. To talk more about that, Nelson D'Souza of iFAST Financial India joins us in our studios. Nelson, we talk about equity mutual funds all the time.
Yes.
What is equity mutual funds? But just before we get down to talking about equity mutual funds, talk about asset allocation, the various assets that are available for investors to invest in, and we'll of course talk about the vehicles that one can use.
Sure. I would say asset classes would be broadly two: equity and debt. When I say debt, for a lot of people it sounds like a loan. For the common man's interest, for understanding, I would say debt is basically investment into safe or almost safe investment options. When you do an asset class allocation, you need to split your investments into equity and debt. The percentage of allocation depends on your age, your risk, your appetite, and the time frame over which you want to stay invested. This, to me, broadly is the breakup of equity and debt. Within equity, for example, you could look at mutual funds, you could look at stock markets, you could look at any sort of risky investment options. On the debt side of it, you could look at fixed income, bonds, NPS, your PF, your EPF, all of that is safe or almost safe could be considered as part of the debt piece. Broadly, you should allocate it based on the basis of your age, if you want a thumb rule. We call it the life cycle theory amongst investment managers. What it means is you should allocate that portion of money to a certain asset class, which is your age. For example, if I'm 35 years of age, 35% of my money should be invested into debt, and the balance should be invested into equity, which is 65%. And as age progresses and you get older, you need to increase your allocation to debt and reduce the allocation to equities, because as you get older, you cannot take more risk than you should. And that is the broad simple understanding of allocation for a layman.
Right. When you talk about, because these are the various assets that you mentioned to us,
right.
Just to pick up on equity, what are the various vehicles that one can use while investing in equity? So you could do direct investment in equity, or you could do it via mutual funds. Correct. Can you talk about the positives and negatives of both before we elaborate more on mutual funds?
You're saying mutual funds per se?
Equity, yes. So if you had to invest into equity, it would either be direct or indirect.
Correct.
So what works and what doesn't?
Direct equity, I would say, would be for sophisticated investors, the ones who are knowledgeable, the ones who have a good understanding of the equities market, and who have the ability to pick enough information before they go and invest into direct equities. Indirect is meant for people who don't have the time and the energy and would require specialized support, and that is where mutual funds come in. Mutual funds are vehicles which were built in a long time ago in the Western world for people who could not get time, neither had the resources to go and figure more information to invest into markets directly.
Right. What are the different types of equity mutual funds? So of course, it's not just one mutual fund that could serve the purpose, right?
Yes.
So what are the different types of mutual funds then?
Broadly, equity mutual funds are of two kinds. There are the diversified kind and the sector/thematic types. Within the diversified side, a lot of them probably haven't heard before: large cap, mid cap, small cap. You have the contra style, you have the value style mutual funds. In the thematic sector space, you probably would invest into anything that is a sector. For example, infrastructure, as I mentioned earlier, or banking. Thematic could mean an idea. For example, the special situation funds that are available in our country. Fidelity had a special situation fund where it would invest in special situations in the markets. So that would mean a thematic fund. So broadly, these two kinds.
So you mentioned thematic and diversified funds. Would it be fair to say that thematic or sector-specific funds are only for savvy investors?
Yes, I would say that for the ones who can take higher risk, for those who have the ability to go through difficult, volatile cycles in the markets, they would make sense.
Also, it's a commonly known misconception that only if you're risk averse, or rather when you're aggressive and you're willing to take risk, should you invest in equities. Is that true? Because more often than not, a cautious investor would still put his money in an FD.
I would say yes, by and large, if you have the risk appetite, you get into these sort of funds. But at the same time, when you're allocating monies as part of a larger game plan for your overall investment portfolio, you should allocate some amount of money for sector thematic sort of funds, because they will give that extra dash of returns over your total portfolio. Because thematic sector funds, while they are risky, they can also return a large amount of money back to you in good times in the market.
Who should be investing in diversified funds? Should a a new investor or individual who's looking at mutual funds for the very first time, should they be focusing only on diversified funds?
Yes, ideally large cap within the diversified space should be for a first time newbie person who's getting into the markets, while the rest could be for those who will progress from there on to in the years to come, and then eventually for those who are risk averse, I would say the large cap space is the better one within the diversified sector.
Right, you've talked about diversified funds and you've talked about thematic funds. What happens, what are large cap, small cap and mid cap funds? Are they also thematic in nature?
No, they're largely dependent on the capitalization of the companies within the mutual fund. Every company has a market cap. The market cap is basically a representation of the stock price into the number of outstanding shares with the general public. So large cap shares, mutual funds typically tend to buy the top funds in the basket of the exchange. For example, if you look at the Nifty top 100 and top 200 could mean large cap. Anything beyond that could mean mid cap, and beyond let's say the 1,000 would typically mean small cap. Small caps tend to be riskier, mid caps tend to be a little less riskier, and large caps are far more safer. But again, equity market risks continue to stay within these sort of mutual funds.
What about there are also funds that are balanced funds or hybrid funds.
Yes.
What are those all about?
Balanced funds are typically funds which balance out an allocation between equity and debt. For example, 65% of the money could be in equities and about 35% in debt. So you get a balance within a single mutual fund, and you want to do asset allocation within one single fund. You don't have the time, you don't have the money to go buy a lot of funds. Maybe a balanced fund style will actually work. Hybrid funds are more or less very similar to balanced funds. It's just that they'll have a few more fancy strategies around them.
What about fund of funds? Because that's also another sort of idea that's catching a lot of attention recently, at least.
Yes, fund of fund is a slightly more complex style of money management. Fund of fund is actually a mutual fund which buys other mutual funds. So you'll have a money manager who studies mutual funds, unlike a direct mutual fund which directly invests into the stock markets. A fund of fund will buy equity mutual funds and have it inside its portfolio. So you get the best of all the fund managers, the best of all funds managed by a single fund manager.
And of course, there's never a free lunch, right, Nelson? So obviously when you're investing through mutual funds where you're getting expertise of a fund manager, what are the sort of charges that are involved when you invest in an equity mutual fund?
Well, the cost of investing into equity mutual funds is probably lowest in the country. I would say that across the world, mutual funds tend to charge far more higher to their investors, but in India, I think we have a far more liberalized rate system, cost system, and I think anyway from 1% to 2% is the maximum that somebody would pay on an equity mutual fund. And I can certainly tell you that this is not the case outside. It will be almost double of this. So Indian investors are far more luckier because the cost of investing in the equity mutual fund is lower in this country.
What is the sort of ideal time horizon one should look at when investing in equity mutual funds?
I would say anyway from 3 to 5 years and plus. Nothing less than that should be the time that one should spend. I think as time progresses, people will tend to increase their long-term views from 3 to 5 to maybe 5 to 10. That is what happens in the international world. But in India, we've still not gotten to the point where people tend to look at 10, 15, 20 years, although I do see a lot of people coming now.
Well, you talked about sector funds, right? I mean, sector funds are flavors of the season, if I can call it that. Right. So if you are investing into a sector fund for 5 to 7 years, chances are it's not going to do too good for you, because you might, for now at least, it's pharma and FMCG, but this story is not going to go on for too long, and infrastructure and the growth sectors will be back in focus. So while you would want to be a long-term investor in equity mutual funds, would you sort of have a shorter-term horizon when you're looking at sector-specific funds? Because they do go in and out of season.
Yeah, I mean, once a sector is actually run out of flavor, once it's given out the returns that you expected it to give, one should exit a sector fund at the peak of it and then get on to something else. Ideally, most people tend to move from a sector fund to more diversified funds to safeguard the returns that they've generated. A lot of them would also move this sort of money into debt or safer investment options to ensure that all of the returns and the capital has been preserved in the future.
What about taxation? How tax efficient are equity mutual funds?
Equity mutual funds probably have one of the best tax structures across the world, in India for that matter, because if you look at the long-term taxation of equity mutual fund, you find that there is no taxation after a year. Less than a year you pay about 15% in taxes, but beyond 1 year you don't pay any taxes at all. This is not true again in the rest of the world, where second year onwards you still continue to pay 10-15% in taxes.
Nelson, if I were to ask you to design a portfolio for an individual who's averagely risk averse, of course, and I'm not talking about equity versus just in equities, how would you sort of allocate it? So how much would you put towards a diversified fund? How much would you put towards a sector-specific fund? How much would you give towards a balanced fund? How would you sort of just design that for somebody who's averagely risk averse?
I would use the same age thumb rule for the purpose of designing within the equity mutual fund space too. I would give more allocation to the diversified large cap space, and I would give the least for the sector space. So it could range anyway from 70 to 80 for the large diversified space, and between 5 to 10% for the sector space within the equity mutual fund allocations piece.
So who in your opinion should be investing in equity funds? Is it only long-term investors?
I would say everybody can. A lot of people have a question, is it a good idea to recommend equity mutual funds to people who are older? I have had questions in the past where older people have asked me if they could put money in equity mutual funds, and I would say yes for those who have had excess spare cash and they want to make the most of the market and are willing to take that risk. So I would broadly say everybody should be investing in equity mutual funds, but technically speaking it should be for those who are starting young, who are starting early, so that they take long-term benefits from the equity markets.
What is the best way to invest in equity mutual funds? I mean, I know financial planners normally insist on doing it via an SIP.
Right.
Can you give us very quickly the advantages and disadvantages of doing a lump sum investment and SIP, and also talk about STP, because that's again something that gets talked about.
Lump sum would be a little tricky, because you'll have to time the market to make the most of bottoms in the market. For example, if the market is down today and you put money in and tomorrow market goes up, you'll make the most of it. But what if the market is really not down and you actually see a market which goes down from here after you invest? So there's a little risk in putting money in lump sum. I would ideally say the SIP route is the best, because it tends to give you the dollar cost averaging benefit, which means you tend to invest through various different cycles of markets and you tend to get an average price for your units. That means that you will be safeguarded from the volatility of the markets. STP is an interesting concept. Instead of probably putting lump sum money straight away into equity mutual fund, you could park that money in probably a debt option, maybe an FMP, maybe a debt fund, and little by little move it on a month-on-month basis into an equity mutual fund. That is also an ideal option for those who have lump sum monies.
What about global equity funds?
Well, global equity funds have been actually catching up in India over the last couple of years. It never was an interesting investment option for a lot of investors, but lately people have realized that they need to diversify beyond India itself. Internationally, investors are used to diversifying their portfolios across different geographies, while in India that was not the case, but lately we find that a lot of people are doing it. It is a good thing because it gives you an extra diversification in terms of geography, not just in asset classes.
Very quickly as well, what are the sort of funds that you're now advising investors to get into, given the market conditions, given what's popular, what's not, given the ratings? What is it that, as a fund house, you're recommending?
Well, there's a whole list of funds that we are recommending for the last 7-8 months. The beginning of this year we came out with a list. I would recommend that investors could actually log on to the website and look at it, but I could quickly give a glance at a couple of them. We have the IDFC Premier Fund that we've been recommending at the start of the year, which is a good equity mutual fund, which is a mid-cap value space. In the large-cap diversified space, we have funds such as the Franklin India Blue Chip Fund. We have the ICICI Prudential Focused Blue Chip Equity Fund, IDFC Sterling Equity Fund, the UTI Opportunities Fund. In the balance space, we have the HDFC Prudence Fund. There's a whole list of funds that's available, and I think it's a great time for investors to get into equities, because the long-term prospects of our country are really good, and I don't think anybody should shy away from getting into the markets right away.
Well, that's all about equity mutual funds and why you should be investing in them. On that note, we'll take a break. We'll come back and take up all your financial planning queries.
The Financial Planner, presented by BSC, Investors Protection Fund.
Asset John Kirkata Nelson writes into us. He says he's just started working about 11 months ago and his income is 30,000 rupees per month. He spends about 11,000 rupees on loan repayment and 10,000 rupees on miscellaneous expenses. He wishes to invest the additional or surplus 9,000 rupees that he has. He needs about 3 to 4 lakh rupees cash after 3 years and plans on investing for the long term. what should he be looking to do?
Well, let me give him the number that he should invest on a monthly basis for the 4 lakhs in 3 years. That's about 9,574 at an annualized return of 10%. I think ideally he should look at investing through SIP mutual funds. I think there are a few funds that I can actually recommend for him. He could put 40% of the money that I just told him in the ICICI Prudential Focus Blue Chip Equity Fund. 30% could be invested into the IDFC Sterling Equity Fund, 20% into the UTI Opportunities Fund, and 10% in a balanced HDFC Prudence Fund. And he should review his portfolio at least once a year.
Well, so that's the advice coming for you. Of course, Nelson highlighting what funds you should be investing in, but you've got to review your portfolio annually. And of course, Nelson, he's only just started his job. Assuming that he does get a salary raise going ahead, do you recommend him to increase his SIP quantum on monthly basis, or that's not required?
No, he should. Incidentally, a lot of people forget to do that. Yeah. They just stay with the amount that they started with. He should certainly increase the SIP component every time he sees an increase in his income. At the same time, he should also try and increase the number of funds, but he should cap it between 6 to 7 over a lifetime.
Right. We've also got another query coming from Manoj Wad when he says he's invested in Reliance Equity Opportunities, Fidelity Equity, Fidelity India Special, SBI Gold, Templeton India Equity Income, and UTI Opportunities. Could you tell him if he should hold these investments or leave any of them? He purchased all these funds in the NFO except UTI Opportunities that he can hold for another 2 years. What is your advice?
Well, broadly, he's got 3 multi-cap funds, 1 global fund, 1 equity specialty fund, and 1 gold fund. If you really look at it, you find that this is a little risky and not really diversified. I would say, why wouldn't you purchase a large cap fund, and why wouldn't you purchase a balanced fund? You should ideally go sell 1 multi-cap fund and 1 equity specialty fund. Recommendations would be ICICI Prudential Focus Blue Chip Equity Fund and the HDFC Balance Fund, and I think these should work for him.
Which one should he exit out of?
I would say in the multi-cap space, he could probably look at the Fidelity Equity Fund, and in the specialty space, he could look at the Fidelity India Special Situations Fund.
And he should hold this for the next 2 years, is
yes,
what
that's right. Yes.
We are advising him. Okay, there's another query coming in from Altaf Ahmed. He says he's 27 and the only earning member of his family. What type of life insurance policy should he take?
Well, he's the only earning member of the family, which means that there is a relatively higher risk on him, and that means his family is at risk if, God forbid, something happens to him. I'd suggest he should go for a term plan. Term plans are cheaper. Term plans tend to give you higher risk covers and at a far lower annual premium. And I'm sure that there are a host of them available in the market, and he could look at any one of them which has the best rate, as well as he should look at one important aspect when it comes to a term plan. Look at the claim repayment history of insurance company too.
Also, any sort of floater plans that he could be looking at, because he's got a lot of dependents, I'm guessing, and he's the only working member. Any family floater, any sort of health insurance?
Yes, I think every time somebody starts off in a career when they're young, they should start off with 2 things. One is to get themselves life insurance, which is a pure term plan, and the other one is to get health insurance for themselves as well as the family members, because one, you tend to get cheaper rates. Secondly, you obviously have to ensure that you and your loved ones are covered right at the beginning of the start of a financial plan.
Right, Altaf, that's the advice coming in for you. You've got to look at insurance, look at term insurance. That's actually quite crucial, given that you are the only earning member of your family. We'll take a break. We'll come back and take some more queries of yours, so stay tuned.
The Financial Planner, presented by BSC, Investors Protection Fund.
Welcome back. You're watching Financial Planner. Nelson, we've got another query coming from Dilip Kumar. He says he's 26, earns 30,000 rupees a month, and he wishes to know if he should invest in an insurance plan or a mutual fund for his retirement savings. I think that question to begin with is completely wrong.
You're right. A lot of them tend to misunderstand insurance to be investment vehicles. First and foremost, in this case, he has to start with insurance, get himself a term plan. Mutual funds are purely for the purpose of investment. It will help him achieve various goals in his life, child's education, retirement, etc. I think it's very clear. Insurance is purely for getting a life cover, and mutual funds are for the purpose of ensuring that your investments, your goals are all achieved. I have recommendations for him here. For the money that he has at disposal for the purpose of investments, he can actually have 40% of his money going into ICICI Prudential Focus Blue Chip Equity and the DSP BlackRock Top 100 Equity Fund. 30% could go into mid-cap and multi-cap funds such as HDFC Mid-Cap Opportunities Fund and the UTI Opportunities Fund. 20% in sector funds such as the Reliance Banking Fund, and 10% in HDFC Prudence Fund, which is a balanced fund.
That's it. We don't really know the quantum of savings that he does per month. I mean, 30,000 rupees is his salary.
Right.
But I'm guessing insurance should be his first concern, or the first thing that he should be addressing before he even comes down to making any sort of investment.
Absolutely. He should buy
what sort
that
of quantum of insurance should we be looking at here? I mean, he's quite young and he's only just started working, I'm assuming.
It should be equal to, it should be the annual salary multiplied by at least the number of years left in his lifetime, and that should be the amount of money that should be the life cover.
And of course, the number of dependents that he has could also play a role.
Yes.
Right, we've got a query from Prashant Khupchandani, very basic but very common. How is the tax treatment in FMP and fixed deposits different?
Well, it's very simple. Although they both fall in the category of debt investments, there are two different investment types. In the case of fixed deposits, the tax incidence rate is equal to the income tax rate for an individual. For example, if I'm in 30% tax bracket, that means, and if I'm making 10% return on a fixed deposit, I would be paying 30% on the return return of 10%. That means I would ideally be making 7% only. In the case of FMPs, tax is different. In the case of FMPs, tax is at 10% without indexation and 20% with indexation. That means anybody who's in a higher salary bracket would tend to benefit from FMPs than the others in the other income bracket.
Investment Ladder, presented by BSC, Investors Protection Fund.
Prashant, that's the advice coming in for you, and that's also all the time we have on this edition of Financial Planner. Thanks for watching.
The Financial Planner, presented by BSC, Investors Protection Fund.